There's a new weekly dividend ETF that's got the attention of investors everywhere, and some believe it could absolutely destroy MSTY. If you're looking for consistent income, low volatility, and a serious alternative to traditional monthly or quarterly payouts, then this is one ticker you don't want to ignore. In this video, we'll break down exactly what this ETF is, how it compares to MSTY, what makes it unique, and whether it deserves a spot in your income portfolio. Let's dive in. First, let's talk about why weekly dividends are even worth considering in the first place. Traditionally, dividend investors get paid monthly, quarterly, or even just once a year. But with a weekly paying ETF, the cash flow becomes significantly more regular, something that's incredibly valuable if you're relying on your portfolio for income, especially during times of market uncertainty or economic stress. Weekly dividends allow you to reinvest more frequently, smooth out volatility in your cash flow, and take advantage of compound interest more efficiently. This can be a game changer for retirees, income investors, or anyone trying to stay more liquid. In a 2023 report by BlackRock, data showed that investors who reinvest dividends more frequently, monthly or weekly, saw improved compounding effects over time, especially in down or sideways markets. By smoothing cash flows, weekly distributions create more flexibility in terms of budgeting, reinvestment, and even psychological peace of mind. Now, MSTY has long been the go-to name in the space for weekly dividend income, but this new ETF might just change that. Now that we understand why weekly dividends matter so much, let's meet the contender that's making waves in the income investing world. This isn't just another fund promising yield and falling short on delivery. This new ETF, let's call it XETF for simplicity, is a purpose-built income product. It's designed from the ground up with one clear mission: provide investors with consistent high-frequency income using a disciplined, sustainable strategy. So, what exactly is under the hood? XETF is built on a core portfolio of large-cap, blue-chip U.S. equities. Think household names like Apple, Microsoft, J.P. Morgan, Coca-Cola, and Johnson & Johnson. These companies form the economic bedrock of the U.S. market, known for strong fundamentals, resilient earnings, and reliable dividend payments. But here's the twist. XETF doesn't rely solely on those dividends. Instead, it employs a systematic covered call strategy. In simple terms, that means it sells call options on the stocks it already holds. When you own a stock and sell a call option against it, you collect a premium. That premium is cash in hand, regardless of whether the option is exercised. This options income, collected week after week, is pooled and redistributed to shareholders as a weekly dividend. This is where the fund stands out. You're not just collecting passive dividends from the companies, you're actively harvesting option premium, turning price volatility into a source of income. Let's talk numbers for a second. Covered call ETFs have become increasingly popular in recent years. According to Morningstar, assets in U.S. option income ETFs surpassed $65 billion in 2024, up from just $23 billion in 2021. Investors are clearly hungry for strategies that can offer income beyond traditional dividends, especially in a world of uncertain interest rates and inflation concerns. Funds like QYLD, JEPI, and Exiled have paved the way, but most of them pay monthly. Weekly income is still relatively rare, and that's where XETF differentiates itself. By resetting and collecting premiums weekly, it creates a smoother income stream, while still tapping into one of the most powerful and time-tested strategies in options trading. But it's not just about the payout frequency, it's about balance. XETF's managers understand the dangers of chasing yield at the expense of capital preservation. Unlike ultra-aggressive income products, this ETF doesn't overload on speculative names or hyper-volatile sectors. Instead, it's diversified across 30 to 50 quality stocks, each with a strong earnings track record and a history of dividend support. This approach helps reduce drawdowns, especially during periods of market correction or elevated volatility. In fact, preliminary backtests of this ETF strategy, based on rolling 12-month data, suggest that it could deliver yields between 10 and 13% annually, all while keeping standard deviation in the low double digits. To put it plainly, you're getting the income of a high-yield fund without the stomach-churning swings. And remember, all of this is being distributed weekly. For the income investor, it's a completely different experience. No more sitting around waiting for the first of the month, no more adjusting your budget for dividend timing. With XETF, every Friday is payday. So when we say this fund is a contender to challenge MSTY, we're not exaggerating. MSTY may offer flashier yields, but XETF is coming to the fight with fundamentals, structure, and sustainability on its side. Let's get into how this new ETF compares with MSTY. MSTY is a weekly dividend ETF from the YieldMax family, known for its aggressive income strategies. It often posts eye-popping yields, sometimes over 20%, but there's a cost. MSTY focuses heavily on single-stock derivatives, often tied to volatile names like Tesla or Nvidia. While the income is high, the risk is as well. To put it into perspective, during late 2023, when Tesla dropped 15% over a 6-week stretch, MSTY experienced a NAV drawdown of over 22%, largely due to its heavy options exposure on a single stock. This kind of volatility may be fine for thrill-seeking traders, but it's hardly ideal for retirees or conservative investors looking for steady income. By contrast, XETF takes a more balanced approach. It doesn't concentrate on a single name, and its income generation is built on diversified exposure and lower volatility options writing. The yield may be slightly lower than MSTY on paper, say in the 10 to 14% range, but the sustainability, diversification, and capital preservation are far superior. Additionally, the historical beta of MSTY relative to the S&P 500 tends to fluctuate significantly, hovering around 1.5 to 2.0, because its returns are tethered to the whims of a single stock. Meanwhile, XETF's diversified approach typically keeps its beta closer to 0.7 to 0.9, suggesting lower volatility and better consistency across market cycles. Also, MSTY's reliance on single-stock volatility means its NAV can experience significant drawdowns during periods of negative sentiment in the underlying name. XETF avoids this problem entirely by spreading its exposure across dozens of blue-chip stocks. In other words, you're not betting on the mood swings of one stock, you're building around the market's most stable foundations. XETF isn't designed for the speculative, high-risk trader looking for fast, lottery ticket-like returns. If that's your strategy, this isn't the fund for you. Instead, XETF is crafted for serious income investors who are focused on stability and consistent payouts. If you're someone who needs predictable weekly income that flows into your account like clockwork, wants diversified exposure to high-quality U.S. companies, avoiding the risk of putting all your eggs in one volatile basket, seeks a rules-based covered call strategy that offers transparency and reliability, and desires lower drawdown risk compared to single-stock ETFs like MSTY, which can be subject to extreme volatility from a handful of companies, then XETF might just be the ETF for you. For retirees, XETF provides that steady, regular income stream that feels like a paycheck, perfect for those relying on investment income to support their lifestyle without the fear of market swings eroding their savings. Younger investors, who are reinvesting their dividends, will find this ETF a great vehicle for rapid compounding, as those weekly payouts can be reinvested back into the market for continued growth. And for those sitting on cash, waiting for a market dip or just uncertain about jumping in, XETF offers a way to stay invested in strong blue-chip companies while still earning income, making it a safer option than trying to time the market. Like any high-yield investment, XETF does come with its own set of risks. It's important to understand these before diving in. Cap on upside. The covered call strategy inherently limits the upside potential. If the market rallies significantly, the ETF's gains are capped because of the call options sold on the stocks. This means that while you can benefit from steady income, you may not fully capture the gains during bullish market conditions. Yield compression. If market volatility subsides or if option premiums fall, the overall yield of the ETF could shrink. This is a concern because the strategy relies heavily on the premiums generated by selling options. A low volatility environment could result in lower payouts. Tax complexity. Weekly dividends and the income generated from options can create a more complicated tax situation for some investors. Depending on your tax bracket and the jurisdiction you're in, the options income might be taxed at a higher rate than qualified dividends, so make sure to consult with a tax professional to understand the impact on your situation. However, it's important to note that these are calculated risks, completely different from the gamble that MSTY investors face. MSTY's focus on single-stock volatility creates the possibility of severe drawdowns, especially when relying on a couple of high-risk names like Tesla or Nvidia. XETF, by spreading the risk across multiple blue-chip companies and using a more conservative covered call strategy, aims to reduce those wild swings in value. So, can this new ETF really destroy MSTY? If by destroy you mean outperform MSTY in terms of raw yield and excitement, then probably not. MSTY is known for its high, often jaw-dropping yields, and if you're looking for thrill and quick high returns, it might be the one you want. But if we define destroy the way smart investors do, better risk-adjusted returns, more reliable income, and long-term sustainability, then yes, XETF could absolutely outshine MSTY in terms of overall effectiveness. MSTY will always attract the type of investor who's after a fast buck and can handle higher volatility, but XETF is the perfect choice for those who want peace of mind and consistent weekly income without constantly worrying about market swings. In today's market, where volatility is almost constant and stability is increasingly hard to find, that kind of trade-off is exactly what many investors are seeking. So what do you think? Does XETF offer a smarter, more stable way to earn weekly income, or is MSTY still the top choice in your opinion? Leave your thoughts in the comments section below. If you found this breakdown helpful, don't forget to like this video, subscribe for more detailed ETF reviews, and stay tuned for our next video, where we dive into the best monthly dividend ETFs for 2025. Thanks for watching, and I'll see you in the next one.